Okay, well, hello everybody. This is Professor Lanzafame again, and we are here to do another video regarding merchandise accounting. And today's objective is to compare the journal entries from a perpetual standpoint versus a periodic standpoint. So hopefully you will understand the difference between the two. A couple of quick little comments before I get started. If you remember, I've done a previous video on perpetual only, and whenever you're working with perpetual, the account that seems to be used probably the majority of the time is this account called merchandise inventory. So merchandise inventory, because we're working with perpetual, it's constantly being updated. It's constantly being increased. It's constantly being decreased. When you acquire it, when you get rid of it, merchandise inventory is the popular account under perpetual. However, under periodic, you rarely see it. Periodic, the inventory is only managed when it's counted. So if you're not counting the inventory, then merchandise inventory, the account, the GL account, doesn't get updated. So we actually have more of a, I would say, explicit way of describing the journal entries, whereas perpetual, it seems like everything we do seems to get thrown into merchandise inventory. Under periodic, you really wouldn't need explanations because you'll be able to tell from the debit and the credit what's actually happening in the transaction. So very explicit accounts. So you may remember me describing definitions of perpetual, and one definition that I gave in a previous video was that under perpetual, the expense of the sale takes place at the time of sale. So kind of remember that. The expense of the sale takes place at the time of sale. Whereas under periodic, the expense of the sale, it takes place when you purchase. So expenses under perpetual, the buying expense, so to speak, is happening when you sell, but under periodic, the expense is recorded when you buy. So under perpetual, expense is recorded when you sell. Under periodic, the expense is recorded when you buy. So two totally different strategies. Remember, companies that use perpetual are usually those ones that probably have a barcode connected with whatever they are dealing with. Periodic, usually you don't see barcoding. Typically, restaurants are the ones that are most famous for using periodic because they find themselves counting on a regular basis. So because they're constantly counting, they're able to update their inventory very, very often. Okay, so I'll continue to remind you of some of these things, but let's kind of start in with a quick review. First off, let's deal with perpetual. And if you notice the transactions to the right, I have here, what if the buyer purchased merchandise for $1,500, terms 210 net 30, FOB shipping point from the ABC company. So a couple of important things in there. First off, FOB shipping point. FOB basically represents freight on board. Some people refer to it as free on board, but basically it's who's responsible for the shipping. If you see the word shipping and then the word point, shipping point, after the word FOB, that means the buyer is responsible for the shipping. The buyer is responsible. If it had said FOB destination, then the seller is responsible. So FOB shipping point, buyer is responsible. So we are, let's pretend we are the buyer. The buyer purchased the merchandise. We're the ones that are buying the stuff. We're the ones that are going to pay the shipping. Okay? So the journal entry that you would make for the very first one would be to debit merchandise inventory. And you would debit that for $1,500. And you would credit, if you see the terms 210 net 30, if you remember, that means you're buying on account. So you're going to credit accounts payable, and then we want to attach the caboose of the company name that we're buying from, and we're buying from the ABC company. So we're going to credit accounts payable also for $1,500. Remember, your debits always have to equal your credits. Never an exception to that rule. Okay. You may want to also include the explanation underneath here. For example, you may want to put the 210 net 30 because you could be buying from other companies and other companies could be giving you different types of terms. So it's important to put that in there as well as the FOB shipping point. So some basic things there. I could also put in there that I bought merchandise, so that may not be a bad thing to put in there as well, but we'll just stick with this. Okay, so notice how merchandise inventory is involved in this transaction. Every single transaction I show you here will involve merchandise inventory. So let's jump to the next transaction. The appropriate party paid the shipping charge. Well, remember, the only way you know if you're the appropriate party are the words following FOB. If it said destination, then the seller pays. If it says shipping point, then the buyer pays. So basically what we're going to do here is we're the ones responsible for the shipping. We, again, if you remember from a previous video, we are going to debit merchandise inventory for the $100 and we're going to credit cash. Did say pay in that transaction. So whenever you see the word paid, you know you have to credit cash. Notice again, merchandise inventory involved. So merchandise inventory is like Mr. Popular in the Perpetual system. So you're constantly updating that account. So if you're confused by this, remember that we're saying that this stuff cost us $1,500, but it cost us $100 to ship it. So how much is this stuff really costing us? $1,600. So if I were to turn around and sell this inventory, if I sold it for, oh, let me sell it for $1,550, thinking it only cost, I only spent $1,500. If I sold it for $1,550, I would be losing money because this stuff really cost me $1,600. So the shipping is part of the cost of that asset. And in case you don't remember, merchandise inventory is a current asset. Okay, the next transaction says the buyer returned merchandise of $300 to the vendor. So we were dissatisfied with what we got. Maybe it was the wrong color, maybe it was the wrong size, maybe things were broken when we received them, or maybe we just changed our minds. So now, whenever you return something, you do the opposite of when you acquired it. So look at that first entry where we debited merchandise inventory and credited AP. We're basically going to flip that. So we're going to debit accounts payable, ABC company, and we are going to debit that for the amount of the return, which is $300, and then we're going to credit merchandise inventory because we no longer have it. We're returning it. So how do you get rid of an asset? You credit it. You got to do the opposite of what you did when you acquired it. The next transaction, the buyer paid the vendor within the discount period. So I've left out dates because I'm being very specific. So in other words, this is within the 10 days. Remember what 210 net 30 means? It means that we have 30 days to pay. But if we pay within 10 days, we get a 2% discount. So that 2 represents how much of a discount you're eligible for, and the 10 means if you pay it in 10 days. You've got a maximum of 30 days to come up with the money, but if you come up with it within 10, you get 2% knocked off of what you owe. Okay, so bottom line here is, remember we had an accounts payable account, and you'll notice in the first transaction I credited AP for $1,500. In this transaction, in the previous transaction, I debited AP for $300. So I currently owe ABC Company $1,200. I'm only allowed to take the discount on what I currently owe. So I can't take it on the original 15. I can only take it on what I currently owe them. So again, if you notice, AP 1,500 credit, and then AP 300 debit, 1,500 minus 300, I currently owe them 1,200. So I'm going to get rid of that AP ABC company, and we're assuming we're paying in full, and the amount that we currently owe them is $1,200. Okay, so now we said in this transaction that they paid within the discount period. So that means we were eligible to take this 2%. Whenever you have a purchases discount, it is recorded through the merchandise inventory account. That may seem weird to you, but remember, merchandise inventory is involved in every one of these transactions. So I'm going to go 1200 multiplied by 0.02 for the 2%, and I get a $24 discount. If I'm saving $24, that means the cash payment is basically the difference between the 1200 and the 24. So as the buyer, we saved $24 by paying, within 10 days. This entry would have been different if I paid after the 10 days. If I paid after, I would be debiting AP for 1200 and I would be crediting cash for 1200 because I didn't take advantage of the discount. Okay, let's take a look at these same transactions, but now let's look at them from a periodic point of view. So let me color code these a little bit here to help us kind of go through this process. We can compare them easier with the colors, I think. Okay, so now periodic. Under periodic, I mentioned earlier that when you're recording the expense takes place when you buy. Look at Perpetual. You don't see any expense account at all in those transactions. All assets, merchandise, 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 merchandise. You see assets being utilized. In fact, there's no expense actually being used under Perpetual because we haven't sold anything yet. Once we start selling, we'll see the difference between Perpetual and periodic. Now, under periodic, the expense is recorded when you buy. So same transaction, buyer purchased merchandise 1500, terms 210 net 30, FOB shipping point from the ABC company. Check this out. We actually debit an expense account called purchases for 1500, and we're going to credit AP, ABC company. The credit remains the same. The difference, the huge difference, is that under periodic, you're recording an expense when you buy. Under Perpetual, you're recording it under an asset. So huge, huge difference there. Okay. Again, I'll probably put the explanation as well. I'll just copy this one because it's the same thing. So again, notice the difference between the two. Under Perpetual, I'm debiting merchandise inventory when I buy merchandise. Under periodic, when I buy merchandise, I'm debiting an expense account. And this is probably the first time we've seen an expense account not end with the word expense. So make a little note to yourself, purchases is an expense account to the company. Okay, so under one system, you're treating the merchandise as an asset. Under the other system, you're treating it as an expense. Then it says the appropriate party paid the shipping charge of $100. Let's make this green. Well, under this transaction, we again want to be very, very explicit. I mean, you'll be able to tell looking at periodic exactly what happened. Whereas under Perpetual, you'll notice that merchandise inventory was debited twice in the blue transaction and in the green transaction. So if you look at the green transaction under Perpetual, if someone said, did you buy stuff or are you paying shipping? You can't tell without an explanation. Whereas under periodic, it's very explicit. You would actually debit freight in, shipping in, transportation in, something along those lines for $100, and you would credit cash. So you can tell for sure what's happening under periodic, whereas under perpetual, you need a little extra help in terms of an explanation underneath those transactions. So you can definitely tell under periodic I made a purchase and I paid shipping, whereas under perpetual, not so clear. You need extra info in those explanations to tell you one's a purchase and one's freight. When the buyer returns merchandise to the vendor, okay, so let's do this one next. So let's put this in, it's too dark. These are lousy colors. Okay, so now basically what's happening here is when we're done comparing perpetual versus periodic, you'll see that I've replaced the merchandise inventory from perpetual to something very explicit under periodic. So I will definitely debit AP again, save myself a little bit of typing, but I'm now going to credit this account called purchases, returns, and allowances. You saw something like this from a selling point of view. We had sales, returns, and allowance, and there was no such thing as purchase returns and allowance under perpetual. But under periodic, these we have new accounts, purchases, freight in, purchase returns, and allowances. Those three do not exist under perpetual. Okay? Notice merchandise inventory yet to be used under periodic. Finally, we want to pay, but the buyer paid the vendor within the discount period. So what's going to happen here, let me just make a little shortcut here. Instead of crediting merchandise inventory, we are going to credit purchases discounts. So look at the difference between the two transactions now. Again, the key difference between perpetual and periodic from a I'll say a from a visual standpoint is that I've replaced the word merchandise inventory with a very explicit account of what's actually happening. So hopefully you can see the differences there. So again, if you were looking at periodic, you could tell exactly what's happening in the first one. Hey, I purchased something. In the second one, oh, I paid shipping. Third one, oh, there's a return. Fourth one, oh, I took advantage of a discount. Whereas if you look at perpetual, not so clear. You know, you can't necessarily tell between the first and the second one which one is the purchase and which one is shipping. And the third one, I guess you would think that that's a return if you know what you're talking about. And then that last one, yep, that's a discount, but you've got to know what you're talking about. So it's almost like you can almost fake it and understanding the information under periodic, whereas under perpetual, if you don't know it, you won't have much clue looking at perpetual. Okay, so now let's do the same type of thing, this time looking at it from a seller's point of view. So again, we're going to use perpetual and periodic. Hang on a second, I want to do this. Just copy this information here. And we'll do it here. Okay, so again, we're making that comparison between periodic and perpetual. All right, so the first transaction says the seller sold merchandise for $800 that cost $200 to the customer, which is XYZ company. Notice the terms 215 net 60 FOB shipping point. So you see FOB shipping point, buyer pays the shipping. We're pretending to be the seller right now. Notice the 215 net 60, we know this is on account. We're the seller, so we're the ones waiting to receive on account, so we'll be using accounts receivable. 215 net 60 means we have We're giving the customer 60 days to pay us, but if they pay us within 15 days, we'll give them a 2% discount. Okay, so let's see how this transaction turns out. So from a perpetual standpoint, again, in a previous video, I demonstrated all of these transactions under perpetual, so this is more of a review. So we're going to debit accounts receivable, XYZ company, and our sale was for $800. So we're literally credit sales now. Oops. And we'll credit that for $800. Remember, your debits have to equal your credits. But if you recall, there's a second journal entry we have to do where we have to record the expense of the sale. Remember, up above all of this, we've been treating every transaction through the merchandise inventory account. We finally get to record the expense of the sale when you sell. So you may remember me saying that at the very beginning of this video. You're going to credit merchandise inventory. Look again, merchandise inventory involved for $200. So we are selling something that cost us $200. We are selling it for $800. Okay, so keep in mind under, let me just put it right here, under perpetual, the cost, which is another way of saying expense, the cost of the sale takes place when you sell. Under periodic, the cost or expense of the sale takes place when you buy. So total different approach on how expenses get recorded under these two systems. So this is super, super important. You definitely want to master that understanding, especially if you're being asked to do these two different systems. Now, a company would not be using both. It's either one or the other. The majority of the companies out there, if they have a barcoding system, they're using perpetual. If they're using periodic, that means they're probably a restaurant of some type. Of course, there's exceptions to everything that is out there, but that's predominantly what you will find. Okay. Now, another thing, purchases, discounts, purchase returns and allowance, and freight in, we'll just do that, only exists in the periodic system. Those accounts do not exist under perpetual. Okay, so let's just put that in a different color just for enhancement here. So purchases, discounts, purchase returns and allowances, freight in only exist in the periodic system. Cost of goods sold does not exist in the periodic system. As a GL account, meaning you don't debit or credit cost of goods sold because it's not a debitable or creditable account. It does not exist in the general ledger under periodic. So notice under perpetual, I did debit cost of goods sold. I can't do that under periodic. It doesn't exist as something I can debit or credit. Cost of goods sold will appear on a financial statement under periodic as well as perpetual, but it's something I calculate. Like on an income statement, I calculate net income, I calculate gross profit, I calculate total expenses. So cost of goods sold under periodic is something that you calculate. It's not something you debit or credit like you can under perpetual. So under periodic, when it's time to record the sale, the only thing that gets recorded is the first part of that two-part entry. So that's what your answer looks like under periodic. You can't debit cost of goods sold because cost of goods sold does not exist as a GL account under periodic. Okay, so interesting information there without a doubt, because that totally can make or break your understanding of this material. So let me just highlight these in green just to remind you of our answers. Okay, let me just put in another space here. Okay, let's go ahead and do the next transaction. The next transaction says the appropriate party paid the shipping charge of $100. How do you know if we're the appropriate party? Well, did it say FOB shipping point or did it say FOB destination? If you're the one selling, okay, that means you're the seller. In order for you to pay the shipping, it would have to say FOB destination. But it says FOB shipping point, so the buyer is responsible for the shipping. We're the seller. So guess what? No entry for us. We can just blow this off. So no journal entry because it said FOB shipping point. Okay, customer returned $200 worth of merchandise that cost $50. Okay, so in a situation like this, what we're going to do is we are going to basically reverse the sale. So we are going to debit sales, but we're going to add a little extra. Debit sales, returns, and allowances. Hopefully I can squeeze it in here. Don't think so, too good. Let me just abbreviate the word returns. And the amount that we're returning, excuse me, the amount that our customer is returning to us is at retail $200. So they're returning $200 worth of stuff. So if they're returning it, they no longer owe us. So I'm going to credit their account. Probably heard that term many times in your regular life. Hey, will you credit my account? You overcharged me. Credit my account. But you're actually talking to the company about their accounts receivable that your name is under. So you're going to debit sales, returns, and allowances, and you're going to credit accounts receivable. You're also going to take into account the costs. So the second part of this entry, you're going to debit the merchandise inventory for the $50. So the stuff that they're returning to us for $200, they have no idea it only cost us $50. It's none of their business. This is something that's from our point of view only. So that's what the entry would look like from a perpetual standpoint. So let's put this in another color here. Let's go with that. And let's go with this. Okay, so now under periodic, again, cost of goods sold does not exist in this system. Cost of goods sold is something we have to calculate along with the value of our inventory. And that would happen through FIFO, LIFO, weighted average, specific identification. So we don't have the means right now to be able to calculate that. So the customer returned $200 worth of merchandise. Under periodic, we would debit sales, returns, and allowances, and we would credit accounts receivable. Again, notice the difference between the two. So we can't credit COGS because COGS does not exist as a general ledger account. So I can't do that second part, just like I couldn't do the second part for the sale. Finally, the last transaction. This is the only one that's identical under both perpetual and periodic. And let's go orange with this one. So if we receive the cash due within the discount period, basically what we would do here is we would debit cash. If the customer took advantage of the discount, we would then debit an account called sales discounts, and then we will credit the customer's accounts receivable. We'll credit their account for the balance. So how much do I want to credit accounts receivable for? Well, in the first transaction, I had $800 that they owed me, but then remember they returned 200, so they currently owe us 600. So 800 minus the 200. So they currently owe us 600 bucks. If they're paying us within the discount period, that means they're taking advantage of the 2%. So 600 multiplied by the 2%, that's going to give us 12, and the difference between the two, 600 minus 12, this is how much cash we're actually getting from the customer. So the exact same entry is done under periodic. It's the only one that's exact. Excuse me. It's the only one that's exactly the same under both systems. Okay, so you've now seen a comparison between periodic and perpetual. Sorry, I got something in my throat. So perpetual, basically, if you remember, the expense of the sale takes place when you sell. Here it is. Here's where we get to write off our stuff. Under periodic, we get to write it off right off the bat. So that's a big, big switch in how things are done. Okay, that's it. I hope you enjoyed this this video on perpetual versus periodic from a journal entry perspective, and I'll be creating more videos as we go along here. All right, have a great day. Bye-bye.